The price of gold is up 37% so far this year. Of course, the year isn't even over yet. And the price of silver is now up 41%.
There is a flight from currency, and that is what I would say is prompting the move into gold. And I would look now, having talked about 3,500 roughly at middle of the year, I would look for 4,000 within the next few months, because there is nothing here to stop the gold from going up further.
Gold and silver markets have delivered a stunning performance, marking a pivotal moment for investors closely tracking precious metals. Gold briefly surged above $3,600 for the first time, before closing just below that level at around $3,590, locking in a weekly gain of nearly 4%. Silver also posted strong gains, climbing 2.8% and finishing above $41, cementing its upward momentum. What's more, the rally has been reinforced by the mining sector, with the GDX index now up 100% year-to-date. Gold prices have climbed 37% so far this year, while silver has gained 41%. And with the fourth quarter still ahead, analysts argue the strongest leg of the rally may be just beginning. In his latest podcast, PeterSchiff highlighted this extraordinary trend, underscoring his long-held view that precious metals remain the most reliable hedge against the dollar's accelerating decline. Schiff stressed that investors who hesitate to buy at the highs risk being forced into even higher entry points as the bull market extends. He pointed out that the US dollar index is weakening rapidly, setting the stage for further capital flight into gold and silver. According to Schiff, the case for metals is not simply about short-term price action, but about structural forces, soaring deficits, a fragile financial system, and the inevitable erosion of fiat currencies. Mining stocks, he added, serve as an additional lever for investors seeking to capitalize on this powerful trend, amplifying gains as metals push higher. Schiff's conviction is clear: the dollar is on the verge of collapse, and gold and silver are entering a multi-year bull run that could carry prices to levels many thought unimaginable. For those still hesitant, he cautioned that waiting for pullbacks could mean missing the rally altogether. His advice was blunt: swap out dollars for hard assets now, before the market gaps even higher. With the metals market moving this aggressively, the question looming over investors is whether they will seize the opportunity in time, or stand aside as gold and silver accelerate into a new era of explosive growth. Before we dive into Peter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
In fact, gold today traded above 3,600 for the first time ever. We didn't close above that milestone, just below it, I think around 3,590, but a 4% gain on the week. Silver also up big, not quite as much as gold, up about 2.8%, not only closing above 40, but closing above 41. And the move continues to be confirmed by the mining stocks. In fact, the GDX is now up 100% year to date. So gold mining stocks have doubled. The price of gold is up 37% so far this year. Of course, the year isn't even over yet. And the price of silver is now up 41%. But I think the fourth quarter, which we haven't even gotten into yet, is likely to be the strongest quarter of the year. And I am very, very confident that now is a good time to buy gold. Was last week a better time? Sure. But if you didn't buy last week, then you got to buy this week. And I know a lot of people, a lot of our customers at Schiff Gold, because I've talked to the representatives, and they say people have been reluctant to buy the highs. I pointed this out on today's podcast on my main YouTube channel. You got to buy the highs. If you don't buy the highs, you ain't buying, right? And the longer you wait to buy the higher the high you're going to buy. So the best thing is to just buy, get rid of your dollars. They are going a lot lower. The dollar index that was down big today is on the verge of collapse. The reason that the dollar is going to collapse, the reason that gold and silver prices are going to soar, and not just for the rest of this year, but for many years to come. I went over all of those reasons on the podcast I just finished. So what I am going to encourage everybody to do today, and it's not that I'm going to be giving up on the Schiff Gold market wrap. And by the way, last week's podcast, I think we had about 50,000 people that watched it and only 18,000 subscribers. So if you watch one of these YouTube videos, make sure at the end of the video, subscribe to the channel. We got to build up the subscribers. I can't have just 18,000. That's kind of embarrassing. So make sure that if you're not a subscriber to this YouTube channel, you subscribe. But you got to go to my other YouTube channel, my main one that has close to 600,000 subscribers. And if you're not one of the subscribers, then you got to subscribe there too. But during that 1 hour podcast, I laid out why I am so bullish in particular right now. And I know it's an hour, but you got to listen to the entire thing because the most important stuff I save for last. Right. So not that the stuff earlier on isn't important. It's all important. But the new information that I think is going to drive this leg of the bull market to unimaginable heights, how high I think the price of gold is going to go and the price of silver. The catalyst for that move is what I discussed in the final 20 minutes of that hour-long podcast. But you gotta listen to the whole thing. So we're gonna put the link in this video and in the description. So as soon as I finish talking, which I'm about to do, the next thing that you do, other than maybe go to the Schiff Gold website and buy yourself some more gold and silver, don't wait for Monday. Because again, we could gap up. Just like last week, I said that we'd gap above 40 in silver, and we did. And I said we'd gap above 3,500 in gold, and we did, right? We gapped above 3,500 on Monday. We could gap above 3,600 next Monday.
Uncertainty around tariffs and inflation is now colliding with the growing risk of stagflation, creating a policy dilemma for both markets and governments. Recent court rulings have kept tariff collections in place, even as their legality is being challenged, meaning consumers and businesses continue to face higher costs. According to DrKomalSri, this policy backdrop has fueled weakness in the US dollar and accelerated a global flight from fiat currencies into gold. As currencies across the board lose credibility, gold has re-emerged as the primary refuge, with forecasts now pointing toward $4,000 per ounce in the near term. The combination of weakening currencies and elevated bond yields is not only reshaping the domestic financial landscape, but also exporting stress globally. At the same time, DrKomalSri notes that tariffs introduce deep distortions into trade flows, driving up costs and eroding efficiency across supply chains. These distortions are not temporary, as some policymakers suggest, but have the potential to push inflation higher for longer. More troubling is the parallel deterioration in labor market data, which hints at weakening economic momentum. Together, these trends create the classic setup for stagflation, a phenomenon last seen on a severe scale in the 1970s, when rising costs and weak growth converged into a prolonged economic crisis. With energy, goods, and services all affected simultaneously by tariffs and policy interventions, consumers find themselves with few alternatives, paying more while earning less.
Let's begin with gold. I began the year by saying gold price is likely to go up, but the dollar is also likely to weaken if you have the Trump tariffs actually imposed. And many of the Trump tariffs are now reality. Now we are waiting to see what the courts say, but from the president's point of view, and the country's points of view, they are paying the higher tariffs. And even the appeals court has said that until the decision is made in October, the president can continue to levy tariffs and collect the revenues. So that is on. But the first part is gold. The imposition of the tariffs, also the various attempts at trying to restrict foreign trade, caused the dollar to weaken. But what happened is we are now in the second stage. And that is what I anticipated when I said the gold price will go up. You have reached a stage where all currencies are being debased. If you don't like the US dollar, what do? You can go get your refuge in euros, British pound sterling, or the Japanese yen. What if you don't like any of those currencies? You have to go to gold. So what is happening in the United States is having a global impact, and the higher bond yields that I think we are going to see in the United States are going to have an impact on foreign countries as well. And so there is a flight from currency. And that is what I would say is prompting the move into gold. And I would look now, having talked about 3,500 roughly at middle of the year, I would look for 4,000 within the next few months, because there is nothing here to stop the gold from going up further. That's one. Second, you mentioned tariffs. And again, I don't believe in tariffs at all. I am again a student of economics, student of international trade, and I believe in free trade in terms of doing it. That is best for the consumers. It is also best for producers. If you produce most efficiently, you should be able to sell wherever you can. And if you do not produce efficiently, then you deserve to go bankrupt. Both of those are managed by the market. Imposition of tariffs is an intervention in the market mechanism. It creates distortions, and that is what I think we are going to go through. And even more important for us in the United States, it is going to push up the inflation rate. I don't believe, as Fed Governor Christopher Waller has said, that it is going to be a one-shot deal. I think it is going to be more long-lasting unless they are removed or canceled. If not, you're going to have a continued increase in the inflation rate, and you're going to have a cutoff, a reduction in total demand. That brings us to the third topic that you raised, stagflation. Normally, when inflation is high, you also have economic growth doing very well. And when there is a recession, the prices do not increase very much because the aggregate demand has fallen off. Stagflation is a very, very rare occurrence. We last had it 50 years ago. And in a stagflation, you have both a recession as well as an increase in prices at a very rapid rate. How does that happen? It happened in the 1970s when one commodity, which was called oil, went up substantially in price, and there were no substitutes. There was no solar energy, there was no electrical energy to substitute for it. Today, even though you don't have one single unit or commodity being attacked, you have a whole range of commodities that are affected by tariffs. So it is not as if the consumer can turn from one direction to the other to avoid tariffs. He or she is going to face tariffs in every direction. And that, I think, is what is going to cause stagflation. We already see that with the weakening of the labor market in various numbers this week. And I think you're going to see the prices have started to move up. Next week, we are going to have the consumer price and producer price index, and that will also show an acceleration in inflation. So all these factors are actually closely related, and I would expect the gold price, tariffs, and stagflation all to be intimately related during the months to come. First of all, every report that we have seen on the jobs front, the ADP report on private sector employment was very poor. Initial jobless claims have risen significantly. So everything says to me that tomorrow, Friday's jobs number is going to be a poor one. The last one we had was 73,000 jobs in July. The expectation is around 75,000, meaning about the same as what we had before, which would be weak job creation, perhaps an increase in the unemployment rate. So, as you said, if the Fed were to counter that with a rate cut, they have to deal with also higher consumer prices and producer prices, which are going to come up next week. That's the quandary you face in a stagflation. Stagflation is a situation when both of them happen, a weak economy and a rapid rise in prices. And the only way to cure it is, as we did during 1981, 1982, to wring inflation out of the system by essentially putting the economy through a wringer. And that means putting the economy through a very severe recession. And that's the only way you can get out of stagflation. You can't do it by cutting rates or increasing rates, because whatever you do, you help the inflation side, then you're going to hurt employment and vice versa. The reason being, people will not accept the solution. They did not accept the solution when Paul Volcker, as Federal Reserve Chairman, did in the early 80s. The farmers sent their tractors to the Federal Reserve building to circle it because they said they can't do anything there. Construction industry people sent bricks over to the Federal Reserve building because there was no construction with those extremely high interest rates. So if you are looking for a popularity contest, you're not going to win it by solving stagflation. You're going to solve stagflation by taking very tough, unpleasant measures. Once you've reached stagflation, the way to do it would be to put interest rates at a much higher level and thereby you put the economy into a very severe recession until eventually the price increases slow down. And that's what we found from the 1980s. So my guess is that that's what we would need to do again in order to do it. And that's why it's a very serious proposition as to how you get out of it. The point being, you never want to get into a stagflation, because once you get into it, the solution is going to be very harsh.
This is the trap now facing the Federal Reserve. Cut rates to support a slowing jobs market, and it risks feeding inflation. Raise rates to fight inflation, and it accelerates recessionary pressures. As both PeterSchiff and DrKomalSri have argued, gold's surge is not just a reflection of short-term speculation, but of a structural loss of faith in currencies and central bank policy. If history is any guide, the US may be heading toward the same painful remedy of the early 1980s, a sharp, prolonged recession designed to crush inflation. The question now is whether policymakers will act decisively, or if investors should prepare for a long period of stagflation, where the only safe havens are tangible assets like gold and silver. That's it for today. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.